Okay. So the next asset class that we can look at to invest for dividend is the shares. Okay, and most people like to invest in Singapore shares is mainly for the dividend. Singapore share is famous to invest for dividend. Okay, so let me just show you these four shares. Okay, these four company shares. Okay, this company share is company A, B, C, and D. So when you want to buy a shares for dividend, there's one thing you need to look at. It's called the trend. Okay, there's one thing you need to look at the trend. The trend of the dividend. There are only three trends: is uptrend, downtrend, or sideways trend. So practically there's many three main type of trend. Okay, let's look at. But with the COVID come in, that disrupt a lot of things. So analyzing shares for dividend based on the trend sometimes can be quite tough. It can be quite tough because it's a black swan event come in, disrupt everything. So you need to look beyond COVID. Okay, you need to look beyond COVID in this aspect. Okay, so let's look at this one. We based on past 5 year dividend track record. Company A 10 10 30. Okay, 10 30. Year 2 10 40. Year 5 10 50. So you can see the dividend actually increase every year. Okay, increase every year. And year 4, the dividend start to drop. Why start to drop? Because the COVID impact start to come. Okay, COVID impact start to come. And the full year, a drastic drop in dividend. Okay, so by looking at the dividend, you can guess that this company is affected very badly by the COVID. Okay, affected very, very badly. It got a 90% drop. Some of you can guess. Anyone want to guess what company is this company? Okay, I'll talk about the company later. So you can see because of this, the current yield is only 0.85%. Okay, so you look at it, based on this dividend is 0.85%. If I look forward, is what happened when after the COVID over, everything back to normal. If the dividend will go back to this level and you're buying at current price, what will be your dividend yield? Okay, so this is something you need to think. What will be your dividend yield? No, sorry, Pavian, it's not SIA. SIA, it's not SIA lah. Okay, so what will be the dividend yield? So this is something you can look at. So is there an opportunity for you to buy this share now? Okay, to capitalize on opportunity. A lot of people say it's too late, too late. It's not really too late. Now it's still on the recovery phase. Okay, so let's look at company B. 28 cent, 28 cent, 30 cent, 30 cent, 30.5 cent. Okay, you can see that the dividend is increasing every year. And the COVID, like nothing to them. The market, whole market crash, whole market come down, and this company give you even more dividends. They mean that this company actually is immune to COVID. Okay, and with this, it give you a 2.94% yield. Okay, so you can see that it's an increasing trend. So this is one. So okay, the company 15 cent, then you drop to 9 cent, then you drop to 9 cent, and this is pre-COVID. Pre-COVID the dividend drop. Okay, pre-COVID already 2 years before COVID come, the dividend start to drop. Okay, so it is not a COVID issue already. It's more like a company issue. After that, the dividend increase. After that, crash because of COVID, and now the dividend is 1.38%. Okay, so company D, you can see 15, 15, 15, 15, 15. Never go up, never come down. Don't care about the market. Up or down, they just give you 15. Okay, some of you may like this type of company. Well, I buy a share already. I don't care about market up and down. My dividend is very constant. Okay, and at current yield is still 3.86% at current market condition. Okay, so these are all four Singapore company. Okay, these are all four Singapore company. Actually, none of y'all guessed correctly. All wrong. Okay, all wrong. Okay, let me just go and look at individual company. Then from there, I just share with you four companies, so how we analyze that. So from there, you will know how to look at dividend stock. Okay, so let's move on to see the first company. This company is called ComfortDelGro. Okay, this company called, I use the 5 year chart as I would look at 5 year dividends. So you can look at ComfortDelGro share price. The high is 302. Then actually it come all the way down. You have to understand, last time the Uber thing, all these issues, they get hit, they come down. Then after that, the saga over already, they went up again. Almost go back to 2002, but come the COVID. Everyone know that Comfort is badly affected by the COVID, okay? And it hit a low of $1.32. And now it's 169. This is today closing price. This is today closing price. Okay, so do you think Comfort will recover after the COVID? Okay, a lot of people always talk of Comfort Delgro as a taxi company. Actually, it is not really correct. ComfortDelGro is one of the largest land transport company in the world. Okay, one of the largest land transport company in the world. They have bus operation in UK. They have bus operation in Australia. They got taxi operation in China. Okay, and of course other places. So it's the biggest bus transport company. And you look at their revenue, about 80% is from public transport. Okay, 80% from public transport. Taxi contribute to only about 20%. Okay, taxi contribute only about 20%. Okay, and because COVID is an international thing, so Australia bus transport overall affected. UK shut down, public transport also affected. Thus, they are affected globally. Okay, globally. And in Singapore context, they not only do the bus, they also do the MRT. Okay, and the MRT now the ridership has dropped a lot, so this indirectly affect them. Okay, but if the COVID were to over, we look forward 1 year later, because when you do dividend investing, you also look at long-term aspect, right? So 1 year later, do you think everything can recover back to normal? Okay, if not, at least 70% back to normal. So if they were to restore their dividend, for them is they will pay out at least 50% of their profit as dividend. That is one of their policy. Okay, that means they make more, you get more. They make less, you get less. Okay, now it's considered their worst case scenario. Worst case scenario, you got about 0.8 something percent dividend. Right? So when your dividend were to increase and restore back, would the share price go up? So this is something to take note. If I say that company, I'll go restore, increase dividend back, okay, because it dropped 90%, increase back by 50%, would the share price also bring up? So if you get it at a low price, your yield will definitely be higher. Okay, your yield will definitely be higher, and your share price also a capital appreciation. So this is how you look at it. Do think that this is not a buy and sell call, okay, but you need to do your own due diligence. Of course, there is risk going forward, but this is something that you, when you look at dividend stocks, you have to look in this aspect, okay, on there. So the second company, the dividend is constantly go up, and this company is called SGX. Okay, SGX is the company that I think is 18 years in Singapore, listed for 18 years already. It's the company that pay dividends for the past 18 years. Okay, paying dividend for the past 18 years. And they have announced that their dividend, they will try to go on an increasing dividend. And they pay dividend 4 times a year. Okay, they pay 4 times a year, and they plan to have increasing dividend. And SGX have transformed very much from the 2008 financial crisis. You cannot analyze SGX on 2008 financial crisis and look at currently now, because it's complete. You can say it's more of a different company already in terms of the way the business nature of the SGX now, and their share price definitely go up. Okay, and they are immune to COVID. Plants they go up already, and this drop is nothing to do with COVID. It's due to the business nature with MSCI. Okay, and today it hit a 5-year high. I think more than 5-year high of $11 already. Okay, and so of course don't chase but just keep this in your watch list, as this is an increasing dividend stocks. Okay, and put that way, it's a monopoly also. Okay, you want to buy any share, you need to go through him, regardless of what platform you use. Okay, all platform need to pay SGX clearing fees. Okay, all need to pay SGX clearing fee. So this is a stocks that is increasing dividend all the way. Okay, the third stocks, the dividend drop. Okay, before COVID. Then after pick up, then it crash. The dividend crash. Okay, anyone want to guess the third stocks? It's also start with an S. Okay, so start with S. Okay, so the third stock is, and lately is in the news but in the news, not in a good way Okay, it's not Singtel. Okay, it's SPH. Okay, in the news, okay, it's SPH. Okay, so SPX, do think no SPX downfall. Actually, sometimes a lot of people blame the current CEO. You have to look further beyond that. The SGX really going down here before this CEO come into office. It's already going down here. This is 5 years. You look even further, it is all the way down one. Okay, it's already going down here. The new CEO coming around this period is already all the way down already. Okay, all the way down. So you need to look at SPX in the aspect. Maybe they start to go up as they start to restructure their business. Okay, put it that way. If the media still in SPH, I think you can forget about SPH. Okay, but the question now, they're going to take off the media and they paid money to get rid of the media. Okay, so that is a certain form of positive news. But the next question you need to ask yourself, when the media go off, what is SPH now become in the future? It become a property company. It become a property from a media company, become a property company. And do they have the expertise? If you want to buy a property stocks, is there other better property stocks in the market for you to consider? Okay, or even bigger property stocks for you to consider. So this is something you need to think note of it, because a lot of people like to buy SPX because of sentimental value. In fact, SPX was in the past was a very, very good dividend stock. Was a very, very good dividend stock. All those retirees really like SPX, but that is in the past. So things will change. So when you buy a stocks for long-term dividend, even for retirement, you really need to look at it. You need to review it one, because nothing will last forever. Nothing will last forever. So you need to look at the next 3 to 5 years, any future. So when you always look forward 5 years, okay, and that's how you constantly need to review. Okay, so this is why you look at SPX. Okay, the last company, the dividend is consistent for 5 years. Actually, it's consistent more than 5 years. Before that, it's also 15 cents. It's very, very consistent. It also starts with an S. Okay, and it's called ST Engineering. The dividend is 15 cents. So you buy ST Engineering many years ago, you see that, my dividend is flat. Okay, regardless of market up and down, it's flat. So some people like is concerned, but do think not, if the dividend is flat, actually your dividend actually is reducing every year, because there's something called inflation. Okay, so the most ideal case of buying a dividend stocks is increasing dividend stocks. Indirectly, it helps you to hedge inflation. Okay, the second choice is the flat one. Of course, the one that you should avoid is dividend going down one. Okay, that's the worst one. But in between that, there's one is dividend up, down, not stable. Okay, not stable. So these are the type of, so the ideal case, look for dividend stocks on the uptrend. But because of COVID, many stocks are being disrupted. So you need to look beyond COVID. Would they be better? Okay, so ST Engineering, I think no need illustrate much. Everyone should know what ST Engineering do. Okay, they got 4 main business: land, sea, air, and electronics. Okay, these are the 4 business, and about 1/4 of the business is on defense. So indirectly, they will have another form of stable incomes. Okay, they have another form of stable income. And electronics, especially in Singapore context, they do a lot of autonomous driving. You can see Sentosa, the bus without driver one. You see our ST Engineering, they are testing all these things. Okay, and that is on ST Engineering. So now let's look at these 4 companies again. Okay, so from there you're able to relate better the dividend history and the company and their business. So this one drop, understandable, market crash, no tourists. Okay, and they need to subsidize the taxi driver. So definitely the market will come down. But would this be a recovery stocks? Okay. So this is something you think, and this one definitely we know that there is a long-term future there, and this one is very, very strong company. It's very stable. It's a very good company. It will be there for quite a long haul. This one is whether do you like this company or not. Okay. So this is not a stock recommendation. I cannot say which one you should buy or you should sell, but this is just to share you how we look at it. Okay. But besides looking at the trend, there's another key thing that you need to look at. Okay, on the dividend aspect is this one called payout ratios. Okay, called payout ratios. Okay, what does a payout ratio mean? Okay, payout ratio, let's look at this. What does a payout ratio mean? Okay, a payout ratio means that if the company would earn $1, right, they pay you 50 cents in dividends. So what does this mean? This means they pay you 50%. Okay, that's called the payout ratio. That means they pay 50% to you. So this is called payout ratios. Okay, so if the company would make $1 in earnings and they pay 120, can they do that? Can. They can pay 120. Okay, then what will be the payout ratio? 120%. Okay, so this is something you need to think. A company earn $1 and how come they can pay 120? Where does this 20 cents come from? Come from where? Come from their pocket. Come from their pocket and come from their reserve and they give it to you. Okay, so this indirectly can be a red flag. There's our conclusion you can draw it is why the company earn $1, pay 120. Okay, one of the thing is not a good way is they just want to inflate the share price. Because Singaporean some of them just blindly go for dividends. Wow, this company dividend so high, just blindly chong in and buy. Okay, and indirectly you will help the share price to move up. Okay, and can create more liquidity, more people buy. Okay, so that is, and the next question is this sustainable? Is it sustainable? I cannot every year take out the money. Just government now use the reserve because of COVID use the reserve, but they cannot use the reserve forever. Will finish one night. Okay, so what happen if cannot sustain? What will happen to them? The company will cut dividends. So when they cut dividend, what happens to the share price? The share price will plunge. Okay, so this is something to think note on that. Okay, another reason why the company take $1 and pay 120 is there is no potential growth future. Okay, there is no growth. I mean, you buy a company, they have no growth already. Their money, no place to go already. They can't grow. So they give it to you as a shareholders, as dividends. Okay, so the same thing. Do we want to buy a company that got no growth future? Okay, no growth future. So this is something that you need to think. When you see something like that, you just ask the management, okay, why are they doing that? See how they explain to you. Okay, and this is what you need to take note. Okay, and let's look at ComfortDelGro. 70%. The dividend increase. So you need to monitor the trend. The dividend increase, but actually the payout ratio also increase. Okay, so payout ratio increase by 5%. But after the dividend increase, the payout ratio maintain means this, if the payout ratio maintain and dividend increase, this tell that they actually earn more money. They earn more money. But after that, the dividend drop and the payout ratio increase. This show that their earnings is coming down a lot. Okay, and they restore back to 50%, and this is what they have now. Okay, so this is sometimes when you look at payout ratio, besides looking at dividend trend, you also need to look at the payout ratio trend. Let's look at SGX. 86, 88, 89, 82. Okay, it hover around 80% range, but with the increasing dividend. And this one, they increase dividend, the payout ratio drop drastically as they make a lot of money during COVID. So it can be a one-time off thing. Okay, it can be a one-time off thing because COVID, a lot of people stay at home and a lot of people work from home. So in a way, a lot of people trade. We got client 3 years never lock in their points account, suddenly call me during the COVID stay home notice, the circuit breaker period, say that then I now got time to look at market already. Okay, because work from home. Okay, so that is why they make the profit. So but it's a drastic drop. So when everything normalized, if they still maintain 80% and with the increased dividend, that's look good. Let's look at SPH, 15 cents, 92%. So cannot tahan, cut dividends. Okay, when they cut dividend, payout ratio also drop lah. Okay, if cut payout ratio drop, then they maintain this payout ratio increase. This show that their revenue continue to drop. They just give you the same dividends to please you. Then they try to increase the dividend or make you more happy. Wow, increase dividend. But do take note, payout ratio actually increased by 30%. Okay, so it's not really that earnings increase a lot lah. Okay, because they take out more money to pay to you. So don't just look at it's an increase. So you need to monitor this also. It's also increased. And of course, here is not applicable. Lose money lah. Okay, lose money. Okay, so become no payout. Practically, they don't make money, but they pay dividends. Okay, so this is not a good case. When I'm losing money and I still pay you dividends. Wow, I'm bleeding already. I still need to take money from the bank and give it to you. So it is not a good thing lah. Okay, let's look at ST Engineering. You can look at their payout ratio on general beside this 81% because that time they make a good profit. It's over 90% one. It's over 90% one. So you can see that ST Engineering, they only keep very little money for themselves. Okay, they can keep very little money for themselves. Okay, but the management say that they got enough money for growth. Okay, they got enough money for maybe because the company is big enough. A small percentage is good enough for growth lah. Okay, and actually they have order books for I think they have order books for next 2 years now. Okay, they have secured $1 billion contract. Practically means that their next 2 year in revenue income already being taken care of already. Okay, so it is pretty stable company at this juncture. Okay, so this is what you need to look at it when you want to invest in a dividend stock. These are just, there's other part, but I just talk about this key parameter. Look at dividend trend, look at payout ratio, okay, and also look at the potential of the company for future growth. Okay, so are the 3 key points you need to look at it when you want to look at dividend stocks. Okay.